And just like that, we're live again, guys. Everybody out there, welcome to another episode of Teach Me Tuesday. Yeah, today is actually Tuesday. How about that? We're moving right along in the week. We had President's Day yesterday. I hope everybody had a good holiday. But let's jump right into today's topic. We're going to talk about using home equity to pay off debt in the new year. Not just in the new year, but all year, however it's going to benefit you. So, for those out there who are already homeowners, are you sitting on 50, 100, even $200,000 in equity while paying 22% interest on credit cards? You got a lot of credit card debt and you own a home and you got equity in it. We're going to talk about how we can eliminate those high yielding debts with what you can do with the equity in your home. So we jump straight into it. We're going to talk about one of the most powerful and most misunderstood wealth tools available to all homeowners. And that's just using home equity to pay off high interest loans. So, LaShawn, Wilmot, y'all doing all right? Yeah, good. Y'all ready to dive into this topic?
Man, let's
Let's
go.
let's talk about, first of all, I'll swing it over to my better half, Miss LaShawn. Can you explain what is home equity? What are we talking about home equity? How is that defined?
Yeah, I mean, that's a great question. Most people will probably define equity probably in the simplest way is it's an intangible cash value that is derived from, what your house is
Trying
worth
to use a
versus
big
what
word.
you owe. So right there in the middle, it's that middle piece. So it's based on if you have a mortgage on your property or not, versus how much you owe, or how much that house is actually worth and versus what you owe on there. That middle ground is called your equity. I think there's so much misconception about equity. I think this is a great opportunity for us to teach you on this Teach Me Tuesday episode,
Mm-hmm.
all about how do you get access to your equity. I know, Wilmot, you probably work with a ton of investors that might try to find different ways to leverage their equity to continue to reinvest into real estate and things like that. So we'll kind of touch on a couple of them. So just jumping right into that, Wilmot, do you tend to see that happens? Do a lot of your investors that you tend to work with, do they typically leverage the equity from other properties that they owned to purchase more? Do you see that?
Oh yeah, I definitely see that with my investors that utilize that equity, and typically it's cheaper for them to pull that equity from a property to purchase more real estate. Instead of going that just getting your like for instance, I have flippers, right? They will say, well, I can get some hard money, but the hard money loans, their interest rates are like super high, right? So you got to make sure everything is lined up, ready to go. You got your contractors in line.
Mm-hmm.
The house is flipped. The house has to sell, or you will pay though that interest, the high interest rate and fees, extensions, if the house everything doesn't run as planned. But some of them are pulling equity from other properties that they might have that they might own in order to fund a flip, so but that's on a you know advanced level. Oh, but I won't say advanced level, I mean, because you can do it with your own home.
Right.
You can use your home equity line of credit, or use the equity from your home to reinvest in another property. So yeah.
Yeah. So I like what you said there. I mean, there are all kind of things that we can do with the equity in our home. And just back to
Mhm.
LaShawn, I did want to give the people like a very basic example. Your home
Mhm.
is worth, or it is appraised at a value of $400,000.
Mhm.
Um, and your loan your mortgage that you have on your home, what you owe on that debt is you owe $250,000. So the equity is the difference between the two, which if you do the math, it's $150,000 of equity that you have. So your bank account may show that, man, you know what, you don't really have a nest egg or anything saved up, but because you have this equity in this home, that's tangible value that you can pull out. You may not be able to pull out everything, but you can get access to some of that, and that's what we're talking about right now. So, Sean, um, I guess why are we even considering talking about using the equity to pay off other debts and things of that sort? Why is that important?
Yeah, so a lot of people, especially I would say during our COVID years, if you bought anytime like in 2020, if you bought even a little bit prior to that, some of those people are kind of sitting on what we consider historically low interest rate. They got those 2s and 3, maybe even 4% interest rates. And a lot of them want to hold on to them very, very tight. They're like, oh, I don't want to ever refinance or tap into my equity. I don't want to do none of that stuff because I don't want to get rid of my great rate. However, the contrary part of that, if you actually go and compare credit cards, like you said before in our opening introduction, is that a lot of people credit cards are at 18 to 20 something percent. Some people have personal loans, car loans at 10, 20%. And so even though you may have this low interest rate on your house, it doesn't compare to some of the higher interest rate. You might be, a lot of people talk about that term house poor. My definition of house poor is when you're trying to hold on to a 2% rate, but yet you're way overextended in these 10, 20, sometimes even 30% interest rate on other debt. So I would strongly consider using the equity in your home to pay down and get rid of that. What do you think, Wilma?
I agree. And I want to say this because I want to make sure people understand this. Like, I guess I want to give this disclaimer. Hey guys, make sure you do your research. There's a lot of gurus out there that, tell you XYZ, do this and you're going to be wealthy in 30 days. But what I want to say is I believe with the experience that's on this podcast, I'll be honest, I've utilized the equity in my house. So this is something I have done personally to, either pay off some things or even reinvest in other investments. You know what I'm saying? So it is truly a benefit to be able to utilize that equity, especially like she just said, paying off. If you got some high interest rate credit cards, guys, this could really save you a ton of money when it comes to the interest you're paying on those credit cards. So if you're sitting on some equity, don't know what to do with it, hey, it might be a good idea. Disclaimer, might be a good idea for you to consider to pay off maybe some of that high interest debt that you might be paying, like those credit cards. So
absolutely. Yeah, and I know, Wilma, I know you mentioned it earlier, just talking about like the ways to access that equity. You mentioned earlier, you brought out HELOC, which was a home equity line of credit. One important thing I want to give a quick disclaimer. Yes, you do have access to this equity in your home, but you still have to qualify to access this money in your home. So there are certain parameters when you're a financial institution or you're lending, whoever you choose to get a home equity line of credit or to get a HE loan through, you still do have to meet certain requirements to be able to, get that money. So definitely, talk to your team right here. We can guide you on what that takes. But let's get back to it. So a home equity line of credit is one way of being able to access your equity. A home equity loan, same thing, is where you just have fixed payments as opposed to having a line of credit that you can pull from. So you're taking out a specific amount that you want, to do to pay off debt, make improvements, whatever it is, go on that dream vacation, all the things that you can do with money. Equity is there for you, is at your grab. Even having an emergency access. I mean, people don't even think about that. Like, man, something drastically happens and I didn't have the money on hand to take care of this. So, I'm not gonna make the mistake again. Maxing out those credit cards that I did, I'm gonna be more intentional and I'm gonna plan ahead. Like, man, I'm gonna pull this money, put it in the nest egg, put it in the savings account, and that way it's always accessible. Or I'm gonna open that line of credit and treat it as my emergency fund, because that line of credit is strictly available for you to pull that equity, and it doesn't have to be used right away. It can be used whenever. So yeah, I mean, there's all parameters about it, but man, I wanted to make sure you guys knew the different ways of being able to access that equity. And then you also have refinancing, which is the other way. If your interest rate ain't at the 2 and 3%, and you're okay with, you know, maybe either lowering your interest rate. You might be someone who bought a home 2 years ago when interest rates were like 7%, and now rates are down into the mid to high fives or low sixes. It could be a good time for you to do a cash out refinance or whatever it may be. But a refinance is also a good option. Um, yeah. Anybody else want to add anything to that?
Yeah, I was going to ask Wilmot, what are you seeing? I know it's been a while since we kind of did a little bit of a market update, but but for your sellers, are you seeing that a good bit of them are walking away, from the closing table with equity? Are you seeing that equity is still on a steady pace where people are maintaining equity? Are they losing equity? Are they still gaining some equity? What are you seeing on your side?
It's been kind of like up and down. I hate to give that answer. I've seen, like, I think we spoke in previous episodes about how the market was softening.
Mhm.
I do see where some sellers are still kind of being more negotiable, softening. They're walking away probably with a little bit less equity now, or more, or netting less at the closing table.
Mm-hmm.
Because we're starting to see a little bit more supply in the area, and also buyers are being more selective. So for example, I have a builder, and man, he's throwing out some great incentives right now so he can get these homes sold. So of course, when you throw out these great incentives, he's taking a little bit less at the closing table. However, I'm still seeing some great buy interest in the market right now on the buyer side as well. So yeah.
Okay, well, good. Thank you for that update. You had to give that little market update in there.
Look,
So the only other thing that that definitely that I would add, which kind of leads us into our last little segue before we wrap up for today, is like using the equity strategy to make it make sense, right? Who does this truly work for? Like, who is this applicable for, right? Of course, if a person is a first time home buyer, they just bought a house, if they only put down, 0 to maybe 3.5%, they necessarily won't have the equity right away to borrow to be able to
Right.
do this. So this is more so geared toward, someone that's maybe been in their home a few years, or someone that's bought their house in a, I call it a high appreciation type market, where maybe they bought new construction, and because of just the demand, it started increasing the value, increasing the prices, and they built equity just over that. Or people who pay, above their minimum payment, on their mortgage payment or whatever, to build some equity. Then they kind of have that, we call it like a little savings account. Your equity, line of credit is kind of like a little savings account for yourself that you can go back and tap back into. You got to have stable income, because as Gavin mentioned, you still got to qualify. So everyone has,
mhm.
who owns a home, and, whose house has increased in value, or they paid their loan down. Everyone has equity available in their house, but everyone don't necessarily qualify to
Right.
borrow against that money. So you have to have stable income, which comes from stable employment and things like that. You still have to maintain, good to decent credit as well, because different programs are going to require you to demonstrate your ability to repay that money back. So just kind of keep that in mind as well. So
Yeah.
that's kind of my little 2 cents. I don't know if y'all guys want to add anything else before we wrap up, but definitely leverage the equity in your properties.
Yeah.
One
Yeah.
of
I mean,
Go
I was
ahead.
gonna say just real quickly. I think it's also important, in tapping into your equity to pay off like debt and things of that sort, especially high interest, credit cards and stuff. Man, you got to also be committed to not running those credit cards back up.
Correct.
You can't just go pay off the debt and be like, I did it, yay, go me, and then go back and do the
And
same thing
then
all over again. It's a tool to get you, out of debt, out of those high interest yielding debts that you've accumulated, and to get you more on a better financial footing. But go ahead, Wilma. You was about to add something too?
I totally agree. That's what you should do, guys. All
Right.
right. When it's a bad idea, to utilize the equity. Gavin, you mentioned one good one right there. Don't respend. Put more money on the credit card when you just paid it off. Another one is using it to fund a higher spending lifestyle. Okay, that's not what it's for, guys. It's not for that.
Mm-hmm.
Let's leave that alone. Okay, we trying to grow in this thing. Okay, and also if you don't have a budget, okay, this is another reason why you shouldn't do it. Okay, so we want you to utilize it.
Responsibly.
Be efficient, be responsible. That's the best word. Accountable. But just make sure, guys, you got a plan. All right, this is to help you build wealth. Okay, not to help you get deeper into debt. Okay, because it can happen if you don't have a plan or a budget. Okay, but that's just my 2 cents.
I love it. Don't be afraid. Lately, I've been meeting with a good bit of financial advisors, and I've learned, because I thought that in order for you to truly utilize a financial advisor or financial planner, that you needed to have like all this money. You need to have thousands and thousands of dollars of wealth. But there are some financial advisors that's out there, and hopefully, if any of them are watching this episode, definitely comment, about your services. But the last few that I've met, you don't have to be wealthy. They will truly work with you where you are. They'll help you create a budget. They'll help you to, start building that wealth, whether you have $100 or $100,000. They will assist you where you are. So that's my little plug for that. So definitely feel free to, reach out to any of us if you guys have anything or any questions regarding anything, all things mortgage. And we'll see you guys next week.
Yep.
All right. Bye.